In this video, I'm going to be speaking about how to manage your risk in trading to ensure that you don't blow your account or lose a lot of your money, because I'm not sure if you've heard the statistics, 90% of traders lose 90% of their money in 90 days. So in order to not be part of that statistic, continue watching this video and I'll explain the best way to manage your risk in trading. Also, I want to quickly say as well, guys, you've been crazy. Like, we've already hit 100 subscribers, which was the first goal. I'm so thankful, I really am. I appreciate each and every single one of you that subscribed or liked or commented or keeps coming back to watch these videos. Honestly, I truly appreciate it. So let's keep the support going. Let's keep this rolling, and hopefully we can get to 500 and then 1,000 and keep growing and helping as many people as possible. But yeah, just want to say before we start, thank you so much. I really, honestly appreciate it. So the first way to manage your risk in trading is quite, it might seem like an obvious point, but a lot of people forget this because they're focusing on how much money they can make and not how much they can lose. But only place amount of money into a trading account that you can afford to lose if you blow the whole account. Not an amount of money that you can afford to lose if you lose a couple of trades, but if you lose the whole account. Now, obviously, through this video, I'm going to explain how you won't blow your whole account if you manage your risk. But put a substantial amount of money that you're comfortable with, that if it does go wrong, that you're not going to be in financial difficulty. Because a lot of people, they get blindsided by, oh, if I only have a small account, I can't make much. And although that might be true, the most important thing is to limit your risk. And it's better to not make as much initially if that means you're not going to lose as much. So you can always make more in the future once you know what you're doing, but especially early on, start with a small account. Like I said, I started with a £500 account. So that meant I wasn't going to make loads when I win, but I also wasn't going to lose loads when I lose. So start with an amount of money that you can afford to lose. And that way, if things do go wrong, because things are uncertain in the markets, you're not going to be in financial difficulty. The next important point to manage your risk is, with that money that you can afford to lose, then only risk 1% of your capital per trade. So, like I said, on my £500 account, I wouldn't make much because I was risking 1%. So I'd risk £5 risk. So if I made 2%, I'd make £10. If I lost 1%, I'd lose £5. So, but the important factor is, although you're not making much, if you can get the consistency and get the skill set on that small account, now with prop firms and or companies out there that will fund you if you're good enough, you'll be able to scale up. But it's important to learn on a small account, make your mistakes on a smaller account, and make sure you risk 1% of your capital. That way, if you have 100 trades in a row, well, the only way to blow the account is losing 100 trades in a row, which is very unlikely. And also, if you're managing your risk, you can see your account gradually going down rather than it's suddenly you've lost 20%, 30%. If you lose 4 trades in a row and you're down 4% on your account, you might sit there and think, okay, I'm going to stop trading for a bit. I'm going to do some maybe back testing. I'm going to learn before I go back to the account, rather than you risk 20% on a trade and end up losing that one trade and losing 20% of your account. So make sure you risk 1% of your account, and that way it can help limit the chances of you losing money. Lastly, use stop losses. So I know there's some people don't like to use them, and obviously it is each to your own. If you don't want to use them, that's your preference. But for me, it's important for me to use stop losses, because on each trade, then I can manage my risk. I know exactly if I'm wrong and I lose and it goes against me, I'm only losing a certain amount per trade. So for example, I risk 1% of my capital. So each trade is going to be, the stop loss is going to be at 1% of my capital if I lose. So if it goes up, if I'm buying and it goes against me and it goes down, I'm only going to lose 1% of my account. And the way you can work that out, there's calculators online, Forex calculators, where you can type in your stop loss. Sorry, you can type in how big your stop loss is in pips, and you can type in how big your account is, and it can work out the size that you need to trade. So what lot size you're going to place your trade to work out exactly how much you're going to be risking. So yeah, number one, make sure you're only trading an account size that you can afford to lose. Don't look at how much you can make, look at what you can afford to lose if it was to go wrong. Number two, only risk 1% of your capital on that amount you can afford to lose, so you can limit your risk when trading. And also use stop losses in case unforeseen events happen. Volatility happens in the market a lot, and you can manage your risk if it goes against you, you're only going to lose a certain amount per trade that you're happy to lose. So yeah, they're the best ways to manage your risk in trading. I hope you guys got value from this video. If you did, please like and subscribe. Tell people that might be interested in this video. Trying to help as many people as possible. So yeah, thanks for watching, guys, and I'll catch you guys in the next video.